Yeah, it sounds like a big caveat, right? A market that grinds itself higher, but coming off the extraordinary gains from 2020 and 21, I'm particularly in Liz and Joe's camp here, where almost back to the basics again. You have to take a position on earnings growth, and profit growth from our perspective should be better than expected. Consensus is out there with a 7 or 8% move. But when you look at some of the trends, particularly consumer spending, despite the growth worries we're all talking about right now, when we look back on all this and we go to the summer of next year and we look back on this, we think this is an opportunity to reposition portfolios. Joe talked about repricing risk. This is actually natural. It's coming at a time of year which it typically doesn't happen because of the so-called Santa Claus rally, but we typically don't have variance we're talking about in normal markets. So the growth worries, the growth shock that's being repriced right now, we think we would fade that. We think growth is actually going to be better than expected, despite the latest worries. We also think the Fed, as Steve said, is going to try to do this in a balanced way. Obviously, they're going to try to thread the needle. But when we say a grinded out market, this is going to sound like it's not a new financial term, but instead of just a bull market, we see a decent uptrend, relatively speaking, particularly since fixed income is an area that should remain under pressure, despite the flattening we've seen recently. As Liz said, the steepening yield curve, we have to be patient. It'll work itself through, in our opinion. And last but not least, this repricing of risk. Think about high quality. Think about a Buffalo type of market, which is a less attractive bull, if you will.
Poor Buffaloes. I hope they're not watching. They're going to get their feelings hurt. Does that include a call on big caps over small caps, which we've seen get pretty hammered? I mean, people were getting all bulled up on small caps for a while. They ran up, and now look at them now.
Yeah, when you have big macro risk, or at least that's what's being repriced in, you get liquidation, and the market's kind of in a corner right now. It's a knee-jerk reaction. So you sell your winners. There's liquidation of the high momentum, what we call big story, little profit areas. We think that that's still going to be under pressure. But when you start to go into this so-called repricing of growth higher, in our opinion, next quarter, even if the Fed removes some of the liquidity, we still see small caps playing catch-up. We see cyclicals playing 10-year, decade-long catch-ups. Mm-hmm. And on the flip side, high-quality cyclicals, i.e. financials, some parts of energy, some parts of materials and industrials, we think is the sweet spot when this macro repricing of risk happens. And small caps, a decade-long repricing to the upside relative to large. So we're overweight small caps relative to large.
Chris, good to see you. Thank you. Chris Hyzy.
Thank you.